war in the Middle East is generating inflation pressures, and the decision to raise rates is robust across a range of scenarios, mapping out how the shock might evolve and affect the medium-term outlook for the euro area.
Hello and welcome to the Week Ahead on Nomura Podcast. My name is Zubin Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 12th of June. Global markets fluctuated again this week, led by some volatility in U.S. equity markets due to AI-related concerns in the tech sector, amid the anticipation of upcoming blockbuster IPOs. The U.S. dollar remains supported, however, as tensions in the Middle East are also re-escalating, although oil markets seem to have taken the latest headlines in stride, with Brent oil remaining below $100 per barrel at the time of this recording. Meanwhile, the ECB delivered a widely expected 25 basis points rate hike in response to inflation pressures, as you heard in that clip, with President Lagarde sounding relatively neutral. That may portend what we could get from a slew of other central bank decisions in the week ahead, including the Fed and the BOJ. We expect a mixed bag, as my colleagues explained in this episode. A few are staying on hold, but some are hiking, but likely mostly balanced in their statements and not pre-committing. I'm joined by Jeremy Schwartz from our U.S. economics team in New York, Josie Anderson from our European team in London, Yuichiro Nozaki from our team in Tokyo, and my co-host Andrew Ticehurst in Sydney. Now let's dive in. Okay, as usual, let's kick off with the US, and I'm joined by Jeremy Schwartz from our team in New York. Hey, Jeremy, thanks again for joining.
Hey, Yuben, great to be back.
Okay, so all eyes on the Fed next week. This would be the first FOMC with Warsh at the helm. So I guess an on-hold decision is a done deal.
Yeah, so again, I think pretty much every Fed official we've heard from seems comfortable with staying on hold for now. So we think there's no real intrigue about the rate decision at this meeting. What is going to be interesting is the communication about potential future moves, because there seems to be some dramatic division between hawks who would like to be kind of already going ahead and signaling hikes for later this year or next year, versus some dovish officials, probably including Chair Warsh, who seem to want to kind of like keep cuts on the table. So, looking at the statement and the SEP, we expect that there's sort of a broad agreement to drop the current forward guidance language with hints at an easing bias. You saw 3 dissents against that statement language at the last meeting. And, while Warsh is dovish and maybe might like the kind of takeaway from an easing bias, he has been very opposed to forward guidance in general in the past. So we think there's actually going to be broad agreement for just removing that language. Where you get to the dot plot, things get a little trickier. So one interesting thing to note is that Warsh himself could not submit dots at this meeting. That's something that's been hinted at in various media reports. And given he seems opposed to kind of having the dot plot in the first place, that's one easy way for him to kind of come in and begin to push back and start to try to reform the Fed's forward guidance. So we might get fewer dots than we're used to, but also for folks who do submit, we think there's actually going to be some disagreement over whether the Fed should be kind of hiking or cutting in the medium term. So we expect the median dots to stay on hold for 2026 and 2027. But we expect 4 to 6 dots showing cuts in 2026, while 3 to 5 probably show hikes in 2026. So, it's not uncommon to get dispersion in the dots. It is quite unusual to have them kind of disagreeing about the direction policy should be going in the first place.
All right. Okay, got it. So, no change in the policy rate, but there could be some small changes in the forward guidance being removed, or the dot plots as well. Speaking of that, this would be the first press conference of Warsh. Would you expect any significant shift in the tone at this one?
Yeah, so again, we think that Warsh would like to be dovish. I think he was appointed by President Trump with the understanding that he would try to come in and cut rates. But at the same time, he does need to establish his credibility on the FOMC as well. So something that's been surprising in the past couple of months is you've seen a number of Fed officials kind of pushing back against some of the arguments that Warsh has been making. So there's been a lot of dismissal of the idea that you can base policy off of trimmed mean PCE inflation, for instance, or that productivity growth from AI is likely to be disinflationary and allow the Fed to cut rates. And even on the balance sheet, which Warsh has long been in favor of reducing, you've had Fed officials come out and kind of at least advocate a more cautious approach and sometimes really push back against it altogether. Governor Barr said that shrinking the balance sheet is the wrong objective. And Governor Waller was even stronger, saying that it was stupid to try to come in and go back to a scarce reserves regime. So again, I think Warsh is on a bit of a tightrope here. He certainly wants to show Trump and Treasury Secretary Bessent that he's still playing for the home team, that he's still going to kind of try to accomplish the goal of lower rates and easier financial conditions. But if he really comes out guns blazing, then we think that he really risks alienating the committee and probably being less effective as a chair in the long run. So our expectation is that he sort of tries to say very little, stay relatively balanced, and keep some of these dovish talking points on the table without necessarily kind of trying to kind of force a consensus or kind of cram a decision down the committee's throat. Because if that happens, it's still a democracy. Everyone just gets one vote there. And he could find that the guardrails kind of go up even more firmly than they already have.
All right. Yeah, that is interesting. Sounds like he's not going to rock the boat too much. And I guess for markets, there is some pricing in of a hike for this year. So based on what you said, there's little chance that the Fed could out-hawk market expectations on this one.
Yeah, so we're not expecting kind of any credible signal of hikes for now. We do think that to the extent that Warsh gives any guidance, he tries to keep cuts on the table. We think pricing for some tightening makes sense. Our call is for a hold, but at this point, given where the data is, it seems that hikes are more likely than cuts in the medium term. You're getting inflation kind of continuing to come in very hot with a pipeline of pressures building with the Iran conflict dragging on and AI demand putting upward pressure on tech products. So again, we don't really see too much relief on the inflation front in the near term. And the labor market remains quite healthy. So we doubt you're going to get the kind of slowdown scare, which we've seen in the past years, which had led the Fed to kind of get into these insurance cutting cycles. Ultimately, we think the Fed doesn't need to hike in the medium term. That's largely a call on the data. And it's largely a call that the consumer is healthy, but you're not seeing accelerating wages and you're not seeing credit growth. So if these price increases continue, you probably get some slowdown in spending. But again, credit data, wage data is often very lagging. So I think if you did start to see those move and you really closed the loop on this kind of inflationary spiral dynamic, then the Fed could be forced into tightening. So again, we think that is still a tail scenario, but it's a meaningful risk, and you're starting to get a lot of data that does have a flavor of overheating to it.
Okay, got it. Yeah, let's leave it here, and thanks, Jeremy.
Yeah, thank you.
Now let's swing over to London, and I'm joined by Josie. Hey, Josie, thanks again for joining. It promises to be a very jam-packed week for you with a lot of central bank decisions.
Hey, yeah, thanks so much for having me.
So, yeah, first up, we just had the ECB decision, and they hiked 25 basis points as expected. So what do you make of that, and where do we go from here?
Yeah, so as you said, we expected this 25 basis point rate rise, and in particular as a signal, and Lagarde herself said that it's a signal that was necessary given the economic situation, uncertainty, and in particular the inflation outlook. Now today they increased their inflation forecast, the ECB did, expected, and now expects inflation to be above target in 2027, and in particular, core HICP inflation to be 2.2% even in 2028. So it does see some likely pressures on inflation continuing over the next couple of years. So those forecast revisions were slightly more hawkish than we expected. Looking ahead, we, as I said, anticipated this rate hike. We also, going into this meeting, were anticipating another rate hike, most likely in July. But these forecast revisions, also only small downwards revisions to GDP growth, were slightly more hawkish than we expected. That being said, in the Q&A, compared to those hawkish projections, Lagarde was slightly softer in tone, and try to, we think, be as balanced as possible, most likely, while still emphasizing that this hike is completely warranted and justified because of that above target inflation that is, of course, all to do with the energy shock due to the war in Iran.
Okay, yeah, got it. And for the week ahead, we have the Bank of England as well. So what's your forecast there in the policy rate? But also importantly, what should we expect in terms of the forward guidance?
Yeah, so actually, in contrast to the ECB, we expect no change in the Bank of England's policy rate on Thursday next week. We do think it will actually also retain its largely non-committal guidance, but a key change that we expect is that we expect another member of its 9-strong committee to prefer to raise rates. So we expect 2 to vote for a hike as opposed to just 1 who did so last time. So we do expect it to be marginally more hawkish in that way, but obviously still the vast majority voting for no change. And a key reason why the Bank of England thinks it can keep its policy rate on hold. A number of members have said that they see holding as active at the moment because prior to the war, they were expecting, and markets were expecting, the Bank of England to cut rates. And in fact, there's even slightly an effect of the fact that markets are anticipating rate hikes by the end of the year. So that itself actually constrains financial conditions already, even without the Bank of England hiking. So it thinks it gives it slightly more time. We do still anticipate a hike in July. Of course, this is all to do with inflation accelerating and the Bank of England, similarly to the ECB, needing to send a signal that it will not allow second round inflation effects to run out of control. But we only expect 1 hike this year from the Bank of England in July.
Okay, got it. And then now we've got other 3 central banks in your region, so Riksbank, Norges Bank, and SNB, all on tap. So what do you expect there?
So from Norges Bank, actually, that's in a slightly different situation to Sweden and Switzerland, because inflation has been quite sticky there for a number of years. So we've already seen Norges Bank hike its policy rate by 25 basis points in May, and it signaled it was likely to do that in March. And of course, the Iran war has added to energy inflation pressures, but it was this sticky inflation that likely prompted that hike. And since that hike, we've already had inflation remains sticky. In fact, in the latest data for May, the underlying measure of inflation was faster than Norges Bank forecast. So we have actually added another rate hike to our forecast, and that is in September. Norges Bank had already signalled that a September hike was a possibility at its March and May meetings, but we think the way the data have developed, it will send a clear signal again at its June meeting that it does still think that second hike this year is needed. And so that is why we have added a September hike. In contrast, in Switzerland and Sweden, inflation remains quite soft in both those countries. And so there is no immediate pressure for those central banks to raise their policy rates, even though inflation is likely to accelerate off the back of this energy price pressure. But at the same time, because inflation remains below target in both of those countries, we don't expect a policy rate hike in either this year.
Okay, perfect. So all 4 central banks next week leaving their policy rates unchanged, but setting up Bank of England and Norges potentially hiking at the subsequent meeting, whereas the rest would be still on hold. So that's very interesting. Yeah, let's leave here. Fantastic. Thanks, Josie.
Thanks a lot, Ewan.
Now, moving to Japan, I'm joined by Nozaki-san from our economics team in Tokyo. Hey, Nozaki-san, thanks again for joining.
Hi, Evan. Thanks for having me.
Yeah, so of course the big event next week is the Bank of Japan on the 16th. And I guess it's been also reported recently that Governor Ueda is being hospitalized. So what do you expect for BOJ next week? Are they hiking for sure?
Yes. At next meetings, the BOJ will need to decide two things. Firstly, as you point out, Governor Ueda will not attend the meeting, but Deputy Governor Himino will chair the meeting, and another Deputy Governor Uchida will hold the press conference. So the absence of Governor Ueda will not affect the policy decision by the next meeting. So we expect the policy rate hike to 1%, but the market has been already priced in the fully priced in the rate hike. So the rate hike itself is unlikely to be the additional focal point on the day. Market attention will instead center on when the next rate hike will come. However, Governor Ueda is unlikely to discuss. Deputy Governor Uchida is unlikely to discuss a specific rate hike path. As before, I think the BOJ will reaffirm that it will continue rate hikes while confirming the economic environment after rate hikes. At this point, it is rather difficult for the BOJ to deliver any additional hawkish message. Our focus for next rate hike is in December.
Okay, got it. And what about the plan for the reduction plan for JGB purchases?
As for reduction plan for JGB purchase, the current plan runs through March 2027. According to media reports, the BOJ appears to be considering ending the reduction at that time, I mean in March 2027. Originally, the cutback in JGB purchases was intended to improve the functioning of the JGB market, which had been deteriorated under large-scale easing by former Governor Kuroda. In last week's speech by Governor Ueda, he said that the market functioning had improved considerably and suggested that the goal of tapering is gradually being achieved. The large amount of JGB which the BOJ has purchased until 2024 will mature in the future. So even after the BOJ stops reducing floor purchases, its balance sheet will continue to shrink at a rapid pace for the time being. In that sense, there is no essential difference between stopping tapering next March or continuing it for another year. On the other hand, the BOJ also showed some awareness of the stability of the JGB market. So while taking into account the recent rise in JGB interest rates, this decision may also reflect an intention not to make the BOJ's reduction in purchases a trigger for market volatility.
Okay, got it. So yeah, again, sounds like the BOJ will be trying to avoid any additional market disruptions from their decisions or any of those announcements. Yeah, thanks again, Nozaki-san.
Thank you.
And finally, we close with the rest of Asia, and I'm joined by my co-host Andrew, who will discuss with me our expectations for a few central banks lined up this week. Hey, Andrew, thanks for joining.
Hey, my pleasure. Absolutely.
So yeah, next week we've got the RBA, and I would say RBA has led the pack in terms of the hiking cycle globally. So what do you expect, and in terms of the cash rate decision, and more importantly, the tone of the RBA?
Yeah, they certainly have led the pack. They've delivered 3 back-to-back rate hikes this year already. And it might sound ironic, but having done that, we're actually very, very confident they're going to announce an unchanged cash rate of 4.35% next week, next Tuesday. And if they do publish a vote count, they don't always, but if they do, I think it's probably going to be almost unanimous. We think that data have generally softened, key data, since the prior meeting. Q1 GDP was a little underwhelming. The unemployment rates picked up. cap use has fallen, and the latest monthly inflation data was a little on the lower side too. The RBA are of a view that policy is now mildly restrictive, but they tend to look for clues in the data to confirm or deny that. And the latest data would certainly be reinforcing that view. The governors previously said they're well placed and they've got space now to watch how the data unfolds. So we think they'll be quite comfortable to stay on hold now and increasingly confident that policy is indeed mildly restrictive. We'll probably get a repeat of the regular warning that the board remains committed to the inflation target and will do whatever it takes to sort of achieve that. But our base case actually remains that they're done now and their rate hike cycle there is most likely concluded. But hey, so that's RBA. I actually also wanted to turn it around and ask you a question because Bank Indonesia was a big surprise to me this week. They delivered an out-of-cycle 25 basis point rate hike. And they're coming back for a meeting, I think, next week too. So what's going on there?
Yeah, that's really interesting. And yeah, they delivered a 25 basis point hike earlier this week, about a week before the scheduled meeting on the 18th. Really, again, a response to a sharp weakening of the currency. But we see this as just a front loading of that hike that we already expected to be delivered on the 18th. So our expectation next week is that they keep the policy rate unchanged. We also know that BI may be looking to keep growth momentum intact, and they've introduced some new instruments to support FX. So they'll use that a bit more for now so they can avoid raising the policy rate back to back. But yeah, again, I'd say this is a relatively close call. 60% chance we're assigning that they're on hold. But 40% of potentially another hike if in the run up to the meeting we get further weakness in the currency.
Okay, got it. And hey, you've been looking at the calendar aside from BI. I think there are a couple of other central banks meeting next week too in the region.
Yeah, we've got the BSP in the Philippines and CBC in Taiwan. With BSP, I'm a little bit more confident in forecasting that they will deliver a measured 25 basis points hike. So that's a second one from the previous meeting where they've also hiked 25. Inflation has eased a little bit, but it still remains above the 2 to 4% target of the central bank. And importantly, core inflation is still picking up. And that's likely to be seen by BSP as a sign of more second round effects from the energy price shock. Because of the war in Iran. And yeah, they will probably also sound hawkish in their guidance with BSP reiterating that it stands ready to take the necessary steps to bring back inflation down to within the target. So similar to what you said about the RBA. Now for the CBC, in contrast, we are expecting also a 12.5 basis points hike on the same day, on the 18th. But we think it's going to be a very close call. The forecast that we have is based on really the upside surprise on inflation. We assign a 55% chance of that hike. If they don't deliver that, we think it's going to be a hawkish hold. In particular, CBC revising up their 2026 GDP growth forecast to above 9%, which for me is really staggering. I guess before we close, Andrew, is there anything else that you're watching in your space? New Zealand Q1 GDP growth is out. What do you expect there? And any potential implications on monetary policy?
Yeah, sure. Kind of ironic. Little New Zealand will finally produce its Q1 GDP data, quite dated now, of course. Look, we do have a few clues on the expenditure side and on the production side. So what we've seen from some of the partial releases is strong retail sales. We've also got some clues from stronger imports and exports and stronger manufacturing activity. Construction looks like a weak spot still, but all up when we add up the bits and pieces, we've got Q1 GDP coming in at around 0.9% quarter on quarter in Q1. That's a pretty solid quarter, certainly above trend. But, what I would say is that January, February, the first 2/3 of the quarter came, of course, pre the conflict in the Middle East. So this data really is pretty dated, and we'll have to take that carefully, I guess. The outlook from here for New Zealand is certainly a little bit softer. I guess, maybe I just finish with a quick comment since we're talking about central banks. RBNZ, they're not out for a little while, not till about 8 July, but there's clearly a rate hike cycle coming into view there. We do have them delivering 3 rate hikes, policies stimulatory. And they are a central bank with a singular inflation remit. So growth looks like it's going to slow from a solid Q1, but inflation's still on the high side. So we do have a couple of rate hikes in our profile for New Zealand. The next meeting in July is touch and go, but we've actually got it currently penciled in, their first hike. They're coming at the following meeting in September.
Okay, great. So it sounds like it's going to be a bit of a mixed bag next week. RBA and BI on hold, CBC and BSP hiking, and then RBNZ later in the year kicking off its hiking cycle. Brilliant. Let's leave it here. Thanks very much, Andrew.
Yep, my pleasure. Thank you.
Well, that's it for now. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast from your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, One Investment Bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.